This is Alan Bush with ADMIS. In the stock index futures, we are seeing prices a little bit lower this morning. There were some overnight gains, however, with corporate earnings coming in better than expected, but some pressure developing more recently with pending home sales here in the U.S. showing a larger than expected decline. Overall, though, I think that the trend toward lower global interest rates will remain supportive for the balance of this year. So even though we're a little lower currently in stock indices, I think we can see a move back to higher on the day, and of course still looking for higher longer term. Over in currencies, seeing the euro currency trading a little bit better. We did see Germany reporting unemployment now falling for the fourth consecutive month, so that's supportive to the euro. Also, we are seeing some pressure coming into the British pound as UK home prices increasing at the slowest rate in 14 months, and the yen under some pressure. Looks like some flight to quality longs being liquidated. No new major negative news out of Greece, although that situation remains very volatile. However, we feel that any flight to quality buying that comes into the yen should be used as a selling opportunity, since the Bank of Japan most likely will be adding more stimulus to their economy within the next couple of meetings, which would be bearish the yen. But the big mover in the overnight trade was the Australian dollar, which is sharply lower. Prospects of a rate decline from the Reserve Bank of Australia have increased. Their meeting is February 3rd, and there is now about a 65% chance, according to financial futures markets, that the RBA will cut rates at that meeting. So we remain bearish on the Australian dollar and on the Japanese yen. Still looking for higher prices longer term in the US dollar. In interest rate markets, some profit taking coming in, especially at the long end after very strong gains yesterday. Of course, the Fed at their meeting contained no surprises in their statement. However, they tended to downplay the influence of low interest rates. Overall, we feel that a relatively slow global economy and low inflation rates will tend to support treasuries, especially at the long end, the 10-year and the 30-year issues. So nothing changing in our long-term views. Still looking for higher prices for the long end of the curve, and this is a trend that should last well into this year. Once again, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.